How's it going? I'm Ryan. Today, I'm going to go to the one trade that I took on NQ. I had a losing trade today, and really, it wasn't even the trade that made me lose, it was myself and my own emotions. I'm going to go into the mistakes that I made and how you can avoid those same mistakes. But first, let's look at the 4 hour time frame and take a look at some of the levels I was watching today and heading into the morning what I was thinking. So, over the weekend, we had a gap up, and then we were kind of in this no man's land up in here in the pre-market before market opened. What I mean by no man's land is we had price move up pretty aggressively in this area, and then we had price move down pretty aggressively in this area. So as you can see, there's not a lot of levels that we had or any like consolidation, resistance, support, etc. to draw these levels off of from a higher time frame, such as the 4 hour. I could have gone down in the 1 hour and maybe found some things, some lower levels, but even there's not a lot. Maybe somewhere in here, you could say, but that kind of coincides with Friday's high, so that's already kind of taken care of. But coming in, like I said, we're kind of in an area where I didn't have any levels. I have a level above us, I have a level below us, and then I had Friday's high a day. But aside from that, not really much to go off of. So I did chart the pre-market highs and lows. Those are those gold levels that you see there. And that's really where we were. So like I said, didn't have much to go off of in terms of levels. Today was really kind of a wait and see, which is where I don't have a bias coming into the day, and I'm just going to let some price action play out and determine how things look based off price action, volume, and how we are responding to levels such as pre-market high, pre-market low, etc. So that's where we're at. Just kind of letting the market open and then going off of the price action there to see where we're at. As you can see, we open, get quite a bit of volatility right out of the bat with this massive hammer. We come up and we break above that pre-market high, form a bit of like a hanging or a shooting star, and then a super aggressive sell-off, all the way bringing us back all the way down to that pre-market low. I'm going to go to the 2-minute chart because it's very evident, and I took a trade pretty early in the morning. So I took a short position on this candle here, right after this green candle printed. I took a short, and I'll show you why. So I've been talking a lot about, there's so many levels here, so much going on, it's kind of disgusting. Well, let's take a look at this. I've been talking a lot about price action and volume and how you can combine the two to get a good idea of where price wants to go. You see that we had a move up, pretty good volume as we break above pre-market high, sputter out a little bit on low volume. You know, we have weak candles, small spread, low volume, and then we get kind of this series of cascading candles with increasing spreads and increasing volume. In fact, you can't make it any more perfect in this. This is literally textbook price action or volume price action analysis, right? We get a big sell-off. We have lots of bearish price action on the 5-minute, right? These candles have a wide spread. They're closing pretty much at the bottom of the candle, very little lower wick, and dropping aggressively. That's what we're seeing on the 5-minute. If we look at the 2-minute, and we can kind of see within that price action what's going on, we see a big ramp in volume, right? You see that volume just stepping up, incrementally going up as we're selling off. That is a huge indicator that there are a lot of people selling, right? We have price dropping aggressively. As it's doing so, we have more and more people participating in that selling. So this is a good sign if you're looking for a downside trade. Now, what do we have on these following couple of candles? We get a green 5-minute candle, and it looks like it's holding that pre-market low. And typically I wouldn't take a short so close to this pre-market low, but the reason why I did so is this right here. Look at the 2-minute. So you can see the volume spike on the 5-minute, and then you can see the subsequent candles pretty low volume. But what's really evident is when you look within those candles on a smaller time frame, the 2-minute, we have volume rising as price is selling down, and then as price starts to kind of bounce. It's not really a bounce. It's pretty weak, right? Price doesn't shoot up. It's not super volatile. Kind of stays in this area. We have wicks both to the up and the downside. Small candle spread. That's not a very strong candle. And then if we look, what's going on in here? The exact opposite of what happened previously, right? Volume spiking as we're dropping, volume dropping as we're bouncing. So that also should show you that there's not many people buying, right? So you see evidence of a lot of people selling as prices coming down, evidence of not very many people buying, holding that price up as it tries to bounce, right? And that's where I entered short. So I waited for this 5 minute to close because I wanted to see a weak close. Now, if we had a pretty aggressive bounce, I wouldn't have taken a short right off that. I would have waited for some more confirmation, maybe another weak 5 minute candle print or something similar. But I felt confident because I saw this exact thing. Ramp up in volume in the selling, ramp down in the volume in the bounce, weak close on the 5 minute, and I entered shortly after. Now here's the issue, and I didn't get a good entry. I would have preferred getting an entry off of maybe like this candle, like the break and the retest of pre-market low would have been a better entry. But I did get an entry on this candle and I just marketed it. So I sold market, which just gives you the best available price at the time. It gives you, it fills you at market price. But we had pretty aggressive sell-off on this subsequent candle. And so I got filled below pre-market low. I got filled somewhere in here around like 928. My first take profit was 30 points below, which was 898. So that would be 30 points. And you can see that we wicked within, it was half a point. It was less than a point from hitting my take profit right here. Then, and this is on me. This is the mistake that I made. So I placed my stop loss above this wick. And I had my 30 point take profit. And then I had a runner. So I took 6 contracts, 5 of which I would have taken profit at 30 points. That's just my standard. And then I adjust my runner based off of price action levels, etc., according to where I think price might go. So where I put my runner take profit? Well, if we think back to when I was talking about this gap up, that gap up correlates perfectly with Friday's high a day. So I placed my take profit just above that, thinking that if we were going to sell off, we would probably fill that gap, right? That's a pretty common strategy. Whenever you see a gap up or a gap down, gaps tend to get filled. Not immediately, but if price is moving in that direction, it's not uncommon. In fact, it's very common for price to fill that gap. Because, if you think of a gap up, you have a rapid jump in price, either to the up or the downside, and that means that there's going to be a lot of unfilled orders in that area that the gap has created, right? Because those are a lot of people that maybe had buy or sell orders in that area, that there's liquidity sitting there because price just gapped and skipped up over those orders. So you might have thousands or millions or however many orders just kind of in that area that never got filled. So that's why gaps tend to get filled, is because there's liquidity in that area. So that's where my runner was, take profit was down here. Now you might be looking at this and say, well, it came down and it would have hit all my take profits. It would have been great. I stopped myself out, and this is the mistake. I didn't let price play out, and I didn't respect my own take profit and stop loss. So the stop loss that I had was above this candle wick, thinking that if we came up and cleared this little swing, this little high that we created off this bounce, that maybe we would continue to go up. But since I had a bad entry, that stop target, or the stop order, was about 30 points. So I had about a 1-to-1 risk to reward. When we closed this 5 minute candle, we came down within a half a point of filling me, and then we pulled all the way back and closed right at that pre-market low. We formed a hammer, and I didn't like that. That psyched me out, right? I watched it get so close to hitting my take profit, and then we pulled all the way back up and closed right at that pre-market low, and that psychologically affected me, right? And a lot of trading is mental, And I failed the mental aspect of this trade. Absolutely. I completely did myself a disservice because, like I said, I had my stop loss above this wick. You see, we came really close, probably within 2 or 3 points, but it didn't hit. And as price was moving up here, I took a small loss rather than taking the full 30-point loss. I thought that this trade was a lost cause, and I didn't want to see that full 30-point loss. And once again, that's psychological, right? I was not mentally prepared to accept the loss if trade went against me, and that's my bad. So I stopped out. But here's how I could have avoided this and stayed confident in my trade. The reason why I entered the trade was still solid, right? We had aggressive selling on volume that validates the aggressive selling. We had a very weak bounce on weak volume that validates that that bounce isn't very, it's not going to, maintain, it's weak. We have another increase in selling as we push down and create new lows on the day. And on this bounce up that psyched me out, what do we have again? Super low volume, right? In fact, the lowest volume that we had all morning. So even lower than this initial bounce that convinced me to get in the first place. So I could have watched this, and also we rejected right off that 13 EMA. So all things, had we broken above that 13 EMA, if we'd seen a big bounce in volume, but we didn't get that. We had high volume on the selling, low volume on the bounce, high volume on the selling, low volume on the bounce, rejecting off the EMA, and it didn't quite hit my stop loss level either. So ideally, I would have let this trade just play out and say if it hits my stop, it hits my stop. But this was me not accepting the risk that I had entered into, right? And I let myself get psyched out. So that was the mistake. And if we look, it would have played out really perfectly. We did come down. We did sweep Friday's high and fill that gap. That would have been a nice trade. I would have been up, about $400 off that one trade. So that's the one trade that I took. From there, price action was pretty choppy. You can see we were bouncing around, holding that Friday high, rejecting off the pre-market low. Kind of stuck in that range for about an hour, and then we got a breakdown, and then some more chop. Finally got a bit of a reversal, and then this is all after hours, so that's kind of not relevant. But that's the lesson. If you're entering a trade, accept the risk that you have set up and just let the trade play out. If you have a stop loss, respect it. Don't take yourself out of a trade because I took a loss on this trade that should have been a win. And that's really it. Now, I did break some other rules. I oversized and revenge traded. It ended up working out. I made a lot of money today, paper money. This is a demo account. This isn't real money. And I took a long in here because we were kind of bouncing around. If I show you the 15-minute chart, we came down, we held that Friday high, that gap fill on the 15-minute. We printed this green candle and we printed this massive hammer candle. I caught some longs and rode this little bounce up with way too many contracts and actually ended the day quite positive. But I'm not even going to go over that. That's not worth reviewing because it's nonsense. It was emotional. It wasn't good. I don't recommend it. And it's embarrassing, quite frankly. I don't want to be doing that. The one legitimate trade that I did take was here. Now, how could I have improved this trade? I think I could have waited for a better entry. I think this entry would have been solid. I also think entering after this 5-minute candle printed, right, where we got that close, that break and close below this level, we got the retest and the break and the close below. Could have entered on the following candle. We get that big move down, that sweep. That would have worked out better with very little drawdown. So this would have been a better entry. I got maybe a little overzealous, but when I saw the aggressive selling, the weak bounce, I figured it was pretty safe to enter. And had I gotten a better entry, actually, rather than getting an entry down here, if I'd gotten an entry kind of closer to the top of that candle, right as that candle opened, then that little spike down would have filled me and it wouldn't even have been an issue in the first place. But shoulda, coulda, woulda. Entries are important. Managing your risk is important. Following your rules is important. And that's just a lot of that's mental. So that's all I got for you. Thank you very much for watching. I'm going to be out. I'll trade tomorrow and might make a recap, but I'm leaving to visit some family for the holidays. So I'll be out. This week is short. Thursday and Friday, the market is closed for the holidays. But I'll be back next week. Thank you so much for watching. I do appreciate it. Hope you have a great day. Peace.